We had one hell of a week in the stock market last week. Tech stocks plunged by more than 10% on a daily basis. The Nasdaq has lost 8% over the last 30 days, and even ARKK's innovation ETF is trading 25% below its all-time high. And also Tesla has lost $230 billion of its market cap. These are just mind-blowing figures to me. But the reason you probably clicked on this video is because your portfolio got hurt badly because you were mainly invested in tech stocks. But don't panic yet. In this video, I'm going to teach you how you can avoid making this mistake again in the future. But first, let me tell you why tech stocks got hurt this bad this week. So many new investors entered the market since COVID happened, and if you are one of them, you already took one of the greatest investing opportunities over the last decade to your advantage. So well done. However, those new investors saw tech stocks rising at rates that are just not sustainable for the long run. The Nasdaq rose by more than 100% over the last year. And it makes sense that tech stocks are doing well during this pandemic while everyone is working from home and traditional industries are suffering. However, so many stocks were inflated and almost forming a bubble. If we had a look at Tesla, for example, its price to earnings ratio hit over 1000 at some point in time. And I could give you so many more examples of stocks where the price wasn't justifying the underlying fundamentals anymore. So this correction is just a healthy pullback to let some air out of the bubble. Another reason that tech stocks plunged was because of the rising bond yields. The 10-year US Treasury bond yields hit 1.6% on Friday, but what influence do bonds have on stocks, and tech stocks in particular? The reason is actually threefold. The first one is the most obvious one. Tech stocks rely heavily on external funding to fund their research and development projects, for example. So tech companies typically have a net cash outflow, which means that they will have to ask funding to either banks or investors to avoid bankruptcy. Since these companies were relying heavily on this cheap funding they had, they will have it a lot harder now. The second reason is because stocks and bonds are competing asset classes for many investors, and because of the rising bond yields, they look much more attractive for traditional investors. They rather settle for a lower but certain yield than leaving their money in these high-risk tech stocks. And the last but most complicated one is this. The way stocks are valued by advanced investors is by using a DCF model, where DCF stands for Discounted Cash Flow Model. So as the name itself says, we discount the future cash flows that the company will generate. And we discount this typically with a close to risk-free rates. And this risk-free rate is a 10-year US Treasury bond yield. And as this rate is rising, this also means that the stock prices need to go down. But if this applies for all stocks, why are tech stocks hit the hardest? Well, most tech stocks barely generate any cash flow as of now, and most of the cash flows and profits will only happen a couple of years from now. And the further these cash flows are in the future, the harder they get discounted. So this is exactly why tech stocks are hit the hardest. I could go on for hours about the DCF model, but it's really mathematical. So if you want me to cover more of this, please let me know in the comment section down below, and I will make a whole series about it. So all of this sounds very bad for tech stocks. Should you sell all of your stocks right now? Of course not. You should look for some amazing growth companies that are heavily discounted right now and load up on those. Since lockdowns are easing all over the world and so many people are getting vaccinated, we will see investors transition more and more towards these recovery types of stocks. You should definitely have a look at the energy sector, since the oil prices are actually higher than before the pandemic. Other industries that still have a lot more room to recover is the tourism industry for obvious reasons, but also the beverage industry. With all these restrictions easing, we can expect some big events happening soon, and people will start over-consuming on the things they couldn't do for many months. But what I'm actually trying to tell you is to diversify your portfolio if you are currently overweight in tech. Of course, if you find the right growth company, your portfolio will outperform the market for sure. But this is especially the hard thing to do, to find the right growth companies that live up to the expectations. Therefore, I always recommend to keep at least 50% or more invested into an S&P 500 ETF. The ones from Vanguard have a really low expense ratio, so the ticker is VOO if you're from the US or VUSA if you are living in Europe. This ETF is still a little overweight into tech, but it is only invested in large cap stocks. So about 25% of it is invested in tech and 75% is invested in other sectors. But because you are so diversified, you benefit either way, both when the tech stocks recover or when investors bet on the recovery of the economy. And it is just a great way to invest for the long term without having to worry about it too much. The index rises on average by 9% each year, so it is a great way to make up for any losses you occur by picking the wrong growth stock for once. And in my opinion, it is a great addition to any type of portfolio and any type of investor. So thanks so much for watching. Please don't forget to like and subscribe, and let me know in the comment section down below which growth stocks you are having a look into to buy during this dip. Thank you so much for watching, and see you in the next one.